Ladies and gentlemen, thank you so much for joining us this morning. We appreciate you carving time out of your busy days to be with us for this post-St. Patrick's Day mid-March Madness market update. My name is Adam Paoli, and I'm the founder and lead wealth planner for Coltiva Wealth Planning Partners. And allow me to welcome you to our next episode in a series of webinars we're hosting alongside pertinent subject matter experts to provide you with useful information about what's important now. As you know, the Coltiva Wealth team remains passionate about educating and helping people. And most of our waking hours are spent face-to-face or now screen-to-screen with a lot of our clients helping them to establish the goals that impact their finances and their families, designing strategies to achieve those goals, and then executing them intelligently. And along with the way, we're really blessed that we build deep relationships with our clients. And we're very passionate about helping them beyond just the management of their investments as part of our process that we call the path to prosperity. And one of the important ways that we do help our clients is to help them understand what's going on, especially in the markets. And when we have volatile times like these, it's even more so important. So to do so, we've invited one of our institutional investment partners to join us, give us their thoughts on the current state of affairs. And without further ado, I'm going to introduce our featured guest, who is CFA Glenn Dorsey, who acts as the Senior VP and Head of Portfolio Management for Clark Capital. And today we're going to touch on a range of topics impacting the markets. And then we're going to end with some questions and answers from you. So you'll see in the bottom of your webinar box, you'll see a box that says Q&A with a couple of comment box. If you have any questions, don't hesitate to send them in along the way of the presentation. You certainly don't have to wait for the end. Glenn will probably cover a lot of your questions because he's very good at what he does. But fire the questions away and we'll make sure that we'll leave some time to get some of those answered again. So Glenn, thank you so much for being with us. Why don't you get started by talking a little bit about volatility? It's been quite some time since we've seen correction territory in the markets, and it seems that some investors have maybe been lulled to sleep by the markets over the 18 months that preceded 2022. So what are your thoughts on the recent volatility we've seen?
Great. Well, thank you, Adam, and good morning, everybody. Thank you for joining. So right now, the way we're viewing this is that this is sort of a garden variety correction in the market. These things are normal, and I think Adam, you hit on a good point that I think people forgot what volatility looked like. Last year we had the market pretty much going straight up. We had one pullback of 5% during the entire year. That's pretty unusual. As I say, that's the equivalent of flying from New York to LA with zero turbulence. It happens once in a while. It's really nice when it happens, but it's not the norm. And what we're having this year is really pretty normal. So we got off the year to a tough start for a couple of reasons. One, people are concerned about inflation, rightfully so. And people were digesting the Federal Reserve suddenly changing directions to start to try to rein in inflation. And then we had some geopolitical events, namely Russia invading Ukraine, to add a little extra excitement into the marketplace. But I'm going to, if it's all right, I'll go ahead and share my screen and walk you through a couple of slides that I think might be helpful to put things in perspective. So, and I said that this is a garden variety correction. What I mean by that is that historically, on average, you get 3 corrections in the S&P 500 of 5% or more per year. This is just average. This is a 70-year average. You get 3 pullbacks of 5% or more per year. You get a pullback of 10% or more on average once a year. And at the worst part of this sell-off that we had from the high that we hit on January 3rd, we were down 13%. So right squarely in the middle of that. And then you get a correction of 20% or more on average every 3 years. Now, we don't see the fundamentals in place that would drive that. And I'll talk a little bit more about that because I think it's important. But just going back to the volatility as normal aspect, this is 50 years worth of returns for the S&P 500. Right. And what this represents is the yellow dots show you where the S&P 500 closed on a total return basis for the year. And the bars indicate the range that it traveled during the year. So over this whole 50-year period, the S&P 500 averaged up 10.9%. So just shy of 11% per year. But when you look, you can see the dots are kind of all over the place, but the bars are really enlightening because it shows that almost every year, no matter what the market ended up at by the end of the year, you spend some time in negative territory. On average, interestingly, 13%, which is exactly where we were at the worst point in this sell-off that we've had. I think 2020 shows a good illustration of that. That's the furthest bar out. You know, at one point we were down over 30% in the S&P 500, and yet we then managed to close up above 15%. And this is a year that with a global pandemic, right? So we've seen that volatility over time with stocks. Now, again, I'm talking about all of this as if there's no humanitarian aspect going on. And we understand that there's the human tragedy that's happening in Ukraine is, it really is just tragic. And we're not unaware of that. We're not callous to it. But, for purposes of today's call, we're really going to focus on what's the economic impact of this on the market and how's the market done in other crisis events. And sadly, like volatility in the market, global crisis events are not unusual either. This chart shows 10 different significant global events. And if we were to fill in every minor one, I wouldn't be able to fit it on the screen. But starting with the Germany invading France in May of 1940, Pearl Harbor, Korean War, Cuban Missile Crisis, a whole bunch of events in the Middle East, 9/11 right here on our shores. And what you'll generally see is that initially the market has a negative reaction because people are afraid and don't know what's happening. And then things tend to settle down. So if you were to average up what the S&P 500 did 1 month after these crisis events, on average, the stock market was down 2.3%. So 1 month later. 3 months later, however, on average up 2.6%. 6 months later, up 6.4%, and a year later, up 10.6%. So you can see there's 3 instances where the market was still down a year after the crisis event on this chart. And in each of those cases, the stock market was already in a bear market, meaning down more than 20% before the event happened, right? So that's really important to realize. And I'd say the top 2, Germany invading France and Pearl Harbor. For those of you who are good at history, you'll remember we weren't doing that well in World War II at this point in time, even a year out. The turning point in the war really didn't happen until the middle of 1942, where we started to look like we had a chance of winning because it didn't look very good before. So that was really, really bleak time period. I know people always say, well, it's different this time, this World War III and all of this. And that we would suggest a couple of things. One is that Ukraine was a relatively easy target for Russia, right? The entire world said they weren't going to do anything. And Russia took advantage of that. And they've had a history of when oil gets up to $100 a barrel, they take another country over. 2008, they went into Georgia. They turned around and went back eventually. But in 2014, they annexed the Crimean Peninsula, which had been part of Ukraine then. And here we are now. So interestingly, in 2014, stocks actually didn't even go down. February 2014, when Russia invaded the Crimean Peninsula, 1 and 3 months after that event, the S&P was up 1.8%, and a year later it was up 14.7%. So that's the most recent guidepost to how the markets reacted. Ultimately, now again, just focusing on what the money side of the equation is, Russia might be a military powerhouse, but they are not an economic powerhouse. So our job is to, again, putting aside the human element of it, how's this going to impact our investments? How is this going to impact the earnings that the companies in which we bought stock, how's these events going to affect them? So Russian economy is $1.6 trillion out of 94 trillion in the world. And these are all to scale. US the biggest, China number 2, Russia is down here. So 1.6 trillion is still a lot, right? But it's smaller than the states of New York or Texas. And in fact, it's about half the size of the economy of California. And so really not that big. Now, we've got all these trade embargoes. Nobody wants to play with Russia anymore or trade with Russia. What does that mean? Well, the US last year did $28 billion in trade with Russia, 22 billion that we exported to them, 6 billion that we imported from them. So 28 total. The economy of the state of Vermont is $33 billion, right? So our trade with Russia is smaller than the economy of Vermont. And that's the smallest state in the country in terms of the economy. So Russia is not that big of an economic player. If we look at the S&P 500 companies and say, okay, well, how much of their revenue comes from Ukraine and Russia combined? It's less than 1%. Okay, so from an impact on earnings standpoint, we don't think there's going to be that big of an impact. We are seeing where we'll see it, and this does ripple through the economy and does affect earnings somewhat, is we've seen a spike in energy prices and a spike in commodity prices. Right now, there's an old expression that says the best cure for high energy prices is high energy prices. And what I mean by that is that any commodity where there's a control over supply, when prices go up, you're going to see more supply come into the marketplace. So, for example, if you look at Baker Hughes puts out a rig count, how many oil rigs are actually operating in the US. So before the pandemic, there were 890 rigs that were working in the US. And early in the pandemic, as we weren't going anywhere. So there was zero demand for energy and prices collapsed. So that rig count went from 890 to 170 active rigs. Well, then what happened? Demand surged, right? All of a sudden we were out, and we can track this through, you can get mobility information from iPhones. We can see how much people are traveling. We started moving again, and there was very little supply. So what happened? Prices started moving up. Then they've been moving up for a while, and the rig count started to come back slowly. It's important to remember that a lot of this new energy independence the US has is from fracking, and that is one of the higher cost ways to get oil out of the ground. Right. So let's say your oil rate, your fracking operation is profitable at $70, $75 a barrel. Well, when it goes from 10 to 30 or 40, you're still not turning it back on. Finally, they got above that, and I think that we were seeing more rigs come back online. And then all of a sudden, with the Ukraine situation, oil spiked up a lot. The last rig count number was 663. So we've seen that spike back up quite a bit, but we're still 225 rigs short of where we were before the pandemic. Oil stays at $100 a barrel. I can assure you that will continue to increase. OPEC has increased their production, and which is, OPEC's a collective bargaining agreement between a bunch of different countries. And I've seen this before, is that they always try to limit the amount of new supply that comes in so that they keep prices high. But then what often happens is they cheat at a country level. They'll produce more and more because they can't resist it with the prices so high. Look at Venezuela, suddenly wants to be our best friend. They're talking to us or releasing prisoners. Why? Do you think there's a coincidence that they see an opportunity to perhaps ship some more oil our way? I don't think so. I think this is the most important graph that I can show. And from a very simplistic standpoint, there's a lot of things that go into factoring values of stocks and all of this, and they're very exciting to watch move up and down. But if you have a business, or somebody that has a business, in very simple terms, if that business makes more money, it's worth more. So it's a pretty reasonable concept. And guess what? the same is true with stocks because we are becoming an owner of a business, and the stock market is just a collection of businesses. So this shows the orange line or gold line shows S&P 500 operating earnings. The blue line shows the price of the S&P 500. And if you here, I'll use an advanced statistical analysis. There's a strong relationship between these. Earnings go up, stock prices go up. There are three notable time periods that we can all remember where stocks did not do well at all. And from 2000 to 2002, what we saw is a collapse of earnings and a collapse of stock prices. The financial crisis from the fall of 07 to early 09, earnings disappeared and stock prices were down 50%. Even the pandemic, short in terms of condensed, but what we saw is earnings for the S&P 500 went down 50% and the S&P 500 went down 34%. So the time periods where stocks are meaningfully down for a period that is just painful is you have seen a complete collapse in earnings. And I hope some of the information I shared about the scale of our trade with Russia and that earnings aren't going to be impacted that much. So we think this is more of an emotional reaction in the marketplace. If you look at the estimates for 2023 for the S&P 500, here's that gold line here, that's 2022, they're up here at $65 a share for the fourth quarter of 2023. That's our backdrop for earnings. You know, the ability to surprise on the upside with energy prices so high is very challenging right now, but earnings nonetheless are continuing to grow, and we've seen a series of the last several quarters. Companies come out, they beat analysts' expectations with their earnings release. The analysts then raise their estimates, and then the companies are beating it again. It's been several quarters in a row. It's going to get harder as we go forward. We may be later innings in the game, but we're not in the ninth inning right now. So the U.S. economy still looks good. I'll show I think if you go back to my original premise that the value of a business is determined by its earnings, and then mathematically there's only one other element that goes into that, and that is what people are willing to pay for earnings. So these 5 gauges represent one or both of those. And the basic premise is if the gauge is to the right of 12 o'clock, it's a positive for outlook for stocks. And if it's to the left, it's a negative. And the good news is there are 4 positive and only 1 negative, right? Economy is strong. It is slowing down. We grew by 5.7% in the US last year. S&P 500 earnings grew 68% last year, right? All-time high, not just where earnings are today, are the highest they have ever been for the S&P 500. So when people say, oh, the stock market's at an all-time high, it has to go down. Well, maybe not if our business is actually earning the most it's ever earned as well. So that's really important. Economy is going to slow down. We want it to slow down a little bit because we're seeing prices go up a lot. But earnings are still growing. Expectations for this year for 9% growth. That's still pretty solid. Consumer is in good shape. We've got unemployment down below 4%. And what we have as a result of all of that, and during the pandemic, we saw an unemployment spike up to 15%. The Federal Reserve came out and did everything in their power to get the economy going again. And the Federal Reserve has a dual mandate. There are 2 things that Congress says it's responsible for. 1 is keeping people working, and 2 is keeping prices under control. Unfortunately, they sort of conflict with one another. So when unemployment spiked up to 15%, the Federal Reserve they lowered interest rates, they bought bonds in the open marketplace, they did everything they could to stimulate the economy. Congratulations, they succeeded. Unemployment's below 4%. However, all of us are back out and spending money, and the supply chain hadn't really caught up yet, right? Our production was not there yet. So if you've got more demand than supply, prices go up. And now what is the Federal Reserve doing? They're going to try and slow down the economy so that the engine doesn't overheat. Right? The last inflation number we saw, it was up 7.9%. That's the highest we've seen in 40 years. That's a big number. We do think it's going to settle down into more of the 3.5% to 4% range. And this is, some people will disagree with me, but keep in mind that inflation is not the price level, it is the rate of change of prices. Okay, so in the inflation numbers that we've seen, about a third of that was from car prices. Now, to really highlight it, used car prices were up 40% year over year, 40%. Now, do you think used car prices are going to go up another 40% from here? Not a chance. So the rate of increase is going to slow down. That is by definition what the inflation rate is. So we think mathematically it's almost a certainty that inflation rate will start to settle down. And the Federal Reserve has now shifted gears from focusing on unemployment to price stability. So we saw it this week. They increased the Fed funds rate first time since 2018 to start to slow things down. And they've indicated there's more to come. None of that's a surprise. And we've been expecting that for a while. Valuations for stocks, they had gotten pretty expensive last year. And the way we look at that is, how much are you paying for $1 of earnings? Just like you would if you're buying a local business. If it makes $10,000, you might be willing to pay $1 million, right? To get or whatever it is, $50,000, and you're paying 5 times earnings. We do the same thing with the stock market. And at the highest level, we were about 25 times earnings, which was high by historical measures. So 2 things have happened. One is, as I mentioned, earnings grew by 68% last year, which is way higher than stocks went up. And now prices have come down with this pullback that we've had in the market. So right now we're actually under about 18 times earnings. Still a little bit high by historical measures, but not really outlandishly overpriced. And in fact, if you move away from some of just the biggest companies, some of the kind of internet technology companies that have a very high multiple, the average stock's actually relatively cheap right now. And there's a lot of good values to be had out there. So we're not overly concerned about that. Investor sentiment is a really volatile gauge. It's like a weather vane, and it just gauges people's fear and greed in the stock market. When people are afraid, that's usually a good time to be buying, right? So what we saw when we came into the year, this is as of the end of last year, we saw a heightened level of skepticism, let's say. People were a little nervous, but they weren't panicking. Well, when we got down 13% and there's global conflict going on, I would say if we were to redo this gauge today, it's probably closer to 1 notch more positive because there's a heightened level of fear. We saw there was a survey done of non-professional investors, and only 14% of those non-professional investors thought stocks were going up. That's amazing. That's really, really low. There's a whole lot of different things that we can see. We monitor mutual fund flows, and we've seen outflows out of the mutual funds, which means people are getting panicky. During the pandemic, for example, we had this gauge all the way to the right, all the way as positive as it can get. You've probably heard of Warren Buffett. He says it pretty nicely. You want to be greedy when people are fearful, and fearful when people are greedy. Our traders say it a little bit less eloquently. They say you want to be buying when people are crying. And what happens when the mutual funds get redemptions, they have to sell securities, and oftentimes they sell at a very attractive price. We own the individual securities on our end. We're not affected by what's happening in the mutual funds, other than to be able to look at the shopping list of things that are going on sale and decide if we want to buy them. So these tend to be opportunities for us. And then the last gauge is interest rates, also positive. One of the things that we look at, there's a lot of good information in interest rates. What we'll do is we'll compare short-term interest rates to long-term interest rates. So we'll look at the yield on a 3-month treasury bill, which is right now about a whopping 0.4%. And then compare it to the yield on a 10-year treasury, so much longer maturity. And we're right around 2.15% there. So long-term rates higher than short-term rates. That means the bond market's pricing in future growth. as the Federal Reserve raises interest rates, they don't control all interest rates. What they control directly is something called the Fed funds rate. That is overnight lending. Can't get any shorter term than that. What will generally happen is short-term rates will move up faster than long-term rates. The smaller that difference, the less positive it is, but still okay. The last three rate hike cycles for the Federal Reserve, stocks were still up and bonds were still up too, in terms of total return. Where we will be worried is if they go too far. In an effort to rein in inflation, they've hit the brake pedal so hard, they've raised short-term interest rates too much, and now they're higher than long-term rates. That's a big warning sign because that has happened before every recession we've ever had in the United States. Somewhere between 3 and 18 months after short-term rates are higher than long-term rates, we've had a recession. So when could that happen? The earliest that we see that short-term rates being higher than long-term rates, and again, that assumes the Fed makes a mistake, would probably be next year, maybe in 2023. So if you start the clock on when's the recession watch, it's probably more likely to be 2024. And this again is assuming they go too far. Could be later 2023 or early 2025, right? That is something we're going to watch very, very closely. But again, from 2015 to 2018, the Federal Reserve raised interest rates 9 times, and the S&P 500 was up almost 21%. 2004 to 2006, the Federal Reserve raised interest rates 17 times. And the S&P 500 was up 11.5%. And bonds were up too. So we've seen this show over and over and over again. It seems like the news channels have never heard of a Fed rate hike cycle before, but I can assure you it's happened many, many times. And there's a pretty good template on how the market has behaved during those time periods. So with that, I'm going to just make my compliance department happy, put up my disclosure page, and then I'm happy to answer any questions that may have come in. So Adam, I will stop sharing my screen and see if you've got any, if we had any questions come in. Or
yeah, Glenn, thank you so much. That was certainly insightful. I think there's 2 main questions that most of the questions kind of funneled around these 2. You mentioned the Russia-Ukraine skirmish, and we certainly have seen these before, but there certainly seems to be kind of a wide range of outcomes, right? From Russia invades, occupies, but has a long fight trying to maintain. They could turn around and walk away, like you said, like they did in Georgia. And there's the potential of obviously something more catastrophic. So as you guys look at the Russia-Ukraine skirmish, what are the ranges of outcomes you see? And really, what do you think is the most probable outcome? And how do we think the market responds to that? You also mentioned kind of a 13% drop from January 3rd to where we were last week, I guess earlier this week. What do you think those range of possibilities are? And do you think that the worst is behind us?
I think the base case is that they're going to come to some sort of an agreement. I don't know what that is going to look like. They've got access to the Black Sea, which is clearly one of their main objectives. They are going to want some sort of safe passage for the energy that flows through Ukraine to the rest of developed Europe. And they're going to want assurance that Ukraine does not join NATO. Right. So, we've reading a lot of different analysis and speaking to people I know that are from there. The biggest concern Russia had was Ukraine joining NATO and having missile defense systems right on their border. They did not want that. Mm-hmm. Now, Putin's in a very difficult position because, well, I know he's an elected official, but he's sort of a dictator. Dictators can never look weak. So whatever deal gets done has to look like they've accomplished their objectives, or else he's not going to do it. Mm-hmm. So I think our base case is that this does not escalate to a World War III situation, which was some of the initial fear and the initial sell-off in the marketplace. Putin, like as I said, has been he's capitalized when energy prices have been high, but he's also he's gone into territories that he knew the rest of the world wasn't going to defend, and Ukraine falls into that category. I think it would be a very, very bad decision on Russia's part if to go into the Baltic states or into Poland or any other country that's backed by NATO, because the dynamics of that change dramatically. They've got their hands full right now with Ukraine. Obviously, it's not gone, I think, the way that they have expected. I think that they'll want to end this in a way that they still look like they got what they wanted. And we'll see how that plays out. So the risk, and we put this as a low probability risk, is that somebody makes a mistake, right? You know, the coordinates on a missile strike are off and it doesn't land in Western Ukraine, it lands in Eastern Poland. That's the risk. I mean, that is a legitimate thing. Now you can't manage the portfolios to the low probability event, because the low probability event by definition means it's unlikely to happen. Could it happen? Sure. Would the market react negatively? Yes. Would tensions escalate? Absolutely. Would we end up in World War III over this? Doubt it. NATO doesn't want to have it either. Russia doesn't want to have it. Nobody really wants to have World War III, because nobody wins with that, right? So I look at motivations. Russia wants a buffer between them and NATO. They wanted Black Sea access, and they want their energy to get through there pretty quickly. So I think all of their goals will be consistent with that, as well as Putin saving face in terms of what's going on.
Yeah. I've told a lot of our clients that when I was the most nervous about this was when the Taekwondo Federation took away his black belt. I said, if he didn't start firing off nukes at that point, I think we're pretty safe. One last question, and then we'll let you go. Just, you mentioned inflation, and you led with, you know, people were concerned about inflation going into the year, and rightfully so. And you gave us some good context about kind of looking out into 23 to 24 for potential recessionary pressures because of that. Talk us through your thought on just what we should be looking for from rate increases, either by number. You kind of mentioned the yield curve as well, but what should the average investor be looking for to say, you know, I want to keep my attention on this with respect to the potential for recession?
I'm actually going to go back and share a slide that I think puts a lot of this in context, because we haven't seen inflation for so long that people are panicking. Keep in mind that the financial news channels that you watch and the political channels that you watch have one goal and one goal only, and it's not to educate you. It is to keep you watching the channel. Mm-hmm. And how do they do that? They either scare you or make you angry. So all you're hearing about is people talking about stagflation, hyperinflation, which, by the way, 2 years ago, all they could talk about was deflation. And now all of a sudden we're at the opposite end of the spectrum. But so I go back and look at the period from the 80s and 90s, right? This is by decade. We saw inflation range from 5.5% to 3% on average for those 2 decades. Stock returns were 17.3% and 18% per year for each of those decades. So way above the rate of inflation. So one, we think inflation is going to settle down. 2, stocks have been historically a pretty good place to weather the storm. Why? Because these companies can raise prices to maintain their profit margins. So when you are able to invest in a company that's raising prices, that's a good way to help offset inflation. They're increasing their dividends, right? We saw in one of our strategies, we saw dividends, about a third of the portfolio in the last 4 months has increased their dividends by an average of 11%. You're worried about 8% inflation, getting 11% more in dividends is not a bad way to do it. And owning a company that's growing their earnings is not a bad way to do it. In my mind, yeah, I understand you need to keep a certain amount in the short term and, you know, save money, have some, you know, some period of time where you know your expenses are taken care of. But if you're worried about inflation, if you've got a whole bunch of extra money sitting earning nothing, and I just met with an organization yesterday that had, you know, millions of dollars sitting idle, earning zero, right? How much money are you earning in a checking account or savings account? Nothing. If prices are going up by almost 8% a year, you're not only earning nothing, you're losing 8% of your purchasing power. So To me, the money that is not working for you is the part that you should be worried the most about with inflation. Stocks and even bonds, where we're getting higher and higher interest coupon payments or interest payments, is really what you want to do. You want to have your money working for you in a period of time where prices are going up. So hopefully that addresses that. And you know, in the short run, and remember, the Federal Reserve doesn't look, they look at what's called core inflation. Core inflation is inflation minus food and energy, which is ironically the two areas that are the most affected right now, because they realize that commodity prices are extremely volatile and they tend to self-correct. When prices are too high, more supply will come on, and even demand may abate a little bit. I'm old enough to remember the 70s, where, you know, oil went from $4 a barrel to 40, and gasoline represented almost 7% of the average consumer spending. And what happened is people carpooled because it was a big deal. Gasoline now, as a percentage of our spending, is about 2.5%. Why? Because we're a lot wealthier now, and we use less fuel per person than we did before. So it's way less impactful than this was in the 70s. So when the comparisons come to the 70s and inflation, it's different. It's a completely different ballgame than it was then. And I think the people that say that are in the camp of trying to scare you to make you watch more TV.
Well, we often say that yeah, the news outlets are certainly not educational. It's designed to make you pay attention. And you said it best, that the only thing that does that is fear and anger, and fear in the financial markets is exactly what you'll see. I'm looking at CNBC right now, and everything's flashing red because the Dow is down 0.5%. So couldn't have said it better. Glenn, thank you so much. We appreciate you lending us your time and your expertise and all your insights. And ladies and gentlemen, we thank you again for being with us today. We hope you found this helpful, and we hope that you find comfort knowing that your team at Coltiva Wealth is here for you. And we're available to discuss what's on your mind with respect to your financial plan, your portfolios, whatever is going on in your mind right now with respect to your investments. And our goal continues to be to do whatever it takes to help you look to your future with anticipation, not anxiety. So please don't hesitate to reach out to us. We're glad to be a sounding board to you. And we hope you continue to be well, make healthy decisions, and we hope to see you soon. Thanks again, Glenn.
Thank you. Be well.